Hi, my real estate enthusiasts. Here I am again. We are going to have the part two of the real estate investment section where we are going to discuss the type of real estate passive income. Specifically, today we are going to talk about rental properties. However, there are a couple of more like REITs, crowdfunding, and syndication. I am Marilyn Santalices, your Tampa real estate advisor with EXP. If you like this video, don't forget to subscribe so you don't miss my new content. There are also different types of rental properties such as residential, commercial, and short-term or vacational rental properties. I'm going to talk about the power of rental income and how owning and renting out properties can create a steady cash flow for you. Here are a few examples that illustrate how owning and renting out properties can create a steady cash flow. Example 1, residential rental property. Imagine you own a residential property, let's say a duplex, with two separate units, and you decide to rent out both units to tenants. Here is how this can create a steady cash flow. The cash flow calculation would be total rental income of $1,200 plus $1,100, which is a total of $2,300 per month. The total expenses is $1,800 plus $400 plus $100 plus $200, which makes a total of $2,500. Then the cash flow would be the rental income minus the expenses, which is $2,300 minus 2,500. That is a total of minus $200. In this example, the property is generating a negative cash flow of $200 per month, meaning your expenses exceed your rental income. However, it's essential to note that the property's value could appreciate over time. And as you pay down the mortgage, the equity you build increases. Additionally, you have the potential to increase rents as the market allows, turning the property into a positive cash flow. Okay, let's see a commercial rental property example. Let's consider a commercial property, let's say a small retail space located in a busy shopping district. You lease this property to a thriving coffee shop, and here is how this can create a steady cash flow for you. First, the income. The monthly rent from the coffee shop would be $3,000, and the expenses are mortgage payment of $2,500 per month, property taxes of $300 per month, insurance of $50 per month, and property management fee of $150 per month. Then the cash flow calculation would be total rental income of $3,000 and total expenses of $3,000 per month. So the cash flow is the rental income minus expenses. For this specific example, the property has a cash flow of $0, meaning the property is generating a neutral cash flow of $0. This means that your rental income covers all your property related expenses. As the property value appreciates and rents increase over time, you might begin to experience positive cash flow. The last example would be a short term vacation rental property. Consider owning a vacation rental property in a popular tourist destination first. You list the property on platforms like Airbnb or VRBO. Here's how this can create a steady cash flow. The average nightly rate is $150. The occupancy rate is 70%. Then the expenses are mortgage payment of $1,200 per month, cleaning and maintenance of $250 per month, utilities is $150 per month, and property management fee, if applicable, of 10% of rental income. So the cash flow calculation would be the monthly rental income 150 by 30 nights by 70%, which is $3,150 per month. And the total expenses would be 1,200 plus 250 plus $150 plus the management fee of the monthly income by 10%. Then the cash flow would be the income less expenses, which is $1,350 per month. In this example, the vacation rental property generates a positive cash flow of $1,350 per month. This demonstrates how well managed short-term rentals in popular locations can generate substantial income even after accounting for expenses. These examples illustrate how owning and renting out properties can lead to a steady cash flow over time, providing you with financial stability and the potential for long-term wealth accumulation. Keep in mind that these calculations are simplified and don't account for all potential expenses, but they give you an idea on how rental income and expenses can interact to create a cash flow. Okay, let's talk now about tips for selecting the right rental property: location, property type, market demand, and some other factors. Selecting the right rental property is crucial for achieving a successful and sustainable passive income stream. Here are some tips to help you make an informed decision when choosing rental properties. First, research the local market. Understand the real estate market trends in the area you are considering. Look at the historical price trends, rental rates, vacancy rates, and overall demand. A strong market can lead to a better rental income and property appreciation. Second, choose a desirable location. Location is paramount. Opt for areas that offer amenities like schools, parks, shopping centers, public transportation, and proximity to employment centers. Properties in desirable neighborhoods tend to attract more tenants and maintain higher occupancy rates. 3. Consider property types. Different property types cater to various tenant demographics. Single family homes might appeal to families, while apartments are suitable for singles or couples. Evaluate the local demand and determine which property type aligns with the market's preference. Fourth, analyze local economy and job growth. A stable and growing local economy often leads to increased demand for rental properties. Research employment opportunities, job growth, and major industries in the area to gauge the potential tenant pool. 5. Evaluate school districts. Properties in neighborhoods with well regarded school districts tend to attract families seeking quality education for their children. This can lead to consistent demand and longer term tenancies. 6. Check for low crime rates. Safety is a top concern for tenants. Properties in low crime neighborhoods are more appealing and tend to retain tenants longer. Research crime statistics and consider safety when choosing a rental property. 7. Analyze rental income potential. Calculate the potential rental income based on local rental rates and the property's futures. Ensure that the projected rental income covers your expenses, including mortgage, taxes, insurance, and maintenance. 8. Calculate cash flow and return on investment, named ROI. Determine the potential cash flow by subtracting all expenses from the expected rental income. Additionally, calculate the return on investment, factoring in appreciation and potential tax benefits. A positive cash flow and attractive return on investment are indicators of a good investment. 9. Account for maintenance and repairs. Factor in the cost of property maintenance and repairs. Properties that require constant repairs can erode your profits and become a hassle to manage. 10. Understand tenant laws and regulations. Familiarize yourself with local tenant laws, regulations, and landlord tenant relationships. This knowledge will help you navigate legal obligations and avoid potential conflicts. 11. Check the property's condition. Conduct a thorough inspection of the property to identify any existing issues or needed repairs. Factor in renovation costs and the time it will take to prepare the property for renting. 12. Evaluate property management options. Consider whether you will manage the property yourself or hire a property management company. A good property manager can handle tenant interactions, maintenance, and other day to day tasks, freeing up your time. 13. Seek professional advice. Consult with real estate agents, local experts, and other investors to gain insights into the local market. Professionals can provide valuable guidance based on their experience. 14. Plan for long-term investment. Approach rental property investment with a long-term perspective. Real estate is an asset that tends to appreciate over time. Be prepared to hold onto the property for several years to maximize your return. Selecting the right rental properties require thorough research, careful consideration, and a clear understanding of your investment goals. By making informed decisions, you can increase your chances of building a successful portfolio of income generating rental properties. And the last thing we're going to talk about today, managing tenants and property. Do it yourself versus hiring property management service. Managing tenants and property is a significant aspect of rental property ownership. One crucial decision you will need to make is whether you manage the property yourself or you hire a professional property management service. Both options have their advantage and considerations. Let's explore each approach. Managing the property yourself. The advantages are: first, cost savings, because managing the property yourself eliminates the cost of property management fees, which typically can range from 5% to 10% of the monthly rent. This can result in higher net income. Second, direct control. You have full control over property related decisions, tenant selections, rent setting, maintenance, and repairs. You are in charge of maintaining your property to your standards. And number three, hands-on experience. Managing your property provides valuable hands-on experience and insight into the daily operation of real estate management. It can be a learning opportunity if you are looking to expand your investment portfolio. Fourth, a stronger tenant relationships. Direct communication with tenants can foster better relationship. You can address tenant concerns promptly and build trust through personalized interactions. And there are considerations on this option. First, time commitment. Property management can be time consuming. Handling tenants' inquiries, maintenance requests, and emergencies can take up a significant portion of your time, especially if you own multiple properties. Second, a skill set. Effective property management requires knowledge of local landlord tenant laws, maintenance skills, negotiation abilities, and conflict resolution skills. Lack of experience in these areas can lead to legal issues or strained relationships. Another thing is the geographical constraints. If your rental property is located far from your residence, it can be challenging to address issues promptly and efficiently. The other option would be hiring property management service. And the advantages are: first, time freedom. Property management companies handle day to day tasks, freeing up your time to focus on other investments, personal pursuits, or your main career. The professional expertise, where the property managers are experienced in tenant screening, lease agreements, maintenance coordination, and legal compliance. They minimize the risk of costly mistakes. Tenant management, where the property manager handles tenant selection, rent collection, and tenant communication, ensuring consistent cash flow and reducing vacancy rates. Fourth, maintenance coordination. Property management service have established relationship with professionals, maintenance enable efficient and cost-effective property upkeep. Considerations. Cost. Property management fees can eat into your rental income. However, these fees justifiable considering the time and stress saved, especially if you own multiple properties. Loss of control. You give up some control over property decisions as property managers make certain choices on your behalf. Clear communication and mutual understanding are crucial. The quality of service. Not all property management companies provide the same level of service. Thoroughly research and interview potential property managers to ensure they align with your goals. Rental property size. Hiring property management might be more cost effective for larger portfolios as the fees are spread across multiple properties. In conclusion, choosing between managing your property yourself or hiring property management service depend on your individual circumstances, investment goals, and personal preference. If you have the time, expertise, and inclination, managing the property yourself can offer a higher net income and direct control. On the other hand, hiring property management can provide time freedom, professional expertise, and reduce stress, making it a suitable option for busy investors or those with multiple properties. Whichever route you choose, the key is to ensure that your chosen approach aligns with your investment strategies and helps you achieve your financial goals. If you find this video helpful, make sure to like, subscribe, and hit the notification bell for more wealth building content. Until next time, happy investment!